Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look at another vol capture trade. The hits just keep on coming. This one on ST Micro, a AI related name. Take advantage of the highest implied volatility ever again, right? All these names not only are the highest ever, but by a large margin, as we'll see in a second. So these will be fleeting trades, in my opinion. Once the vol breaks, we should see some very quick profits coming in. So let's jump in and take a look, shall we? As always, we like to use that fusion approach, taking a look at the fundamental, technical, and probably most importantly, implied volatility analysis. So here's the scanner from yesterday. You can see ST Micro made kind of the top of the list here, right, with over 35,000 contracts trading, more than double the normal volume of 16,000. More importantly, implied volatility at 100%. That means option prices have never been this expensive over the past year. We'll take a look in a second. Basically, haven't been this expensive ever, right? So you're fully rewarded for selling these options, right? You can get a big cushion on the trade, get a big credit, combine the two, and have a plenty of room for the stock to move around, and especially on the short term where IV is even richer, take advantage of that as well. So from a fundamental standpoint, certainly ST Micro, not cheap by any stretch. Here is a 3-year chart of price to sales, right? You can see trading basically at the highest level by far we have seen over the past 3 years. A year-to-date look shows that it got barely above 5 times price to sales, which is certainly rich to say the least. It's been hovering around 2 times, so certainly the upside I think will be somewhat muted given the fact that interest rates aren't coming down. Multiple expansion should be difficult. Price to earnings, absolutely one parabolic. Here's a 10-year chart, as you can see, going over 200, right? Here is price to earnings on a year to date where it almost reached 250, but now back towards 200. So the fundamentals point at least to the upside being capped here on ST Micro. As far as the technicals, here's a look at the chart. You can see that it did trade up to that $80 level and got rejected. So this is a significant top, I think, in the stock. Down below, as we know, right, stocks don't go down too hard in this market environment. But as you can see here, implied volatility, and we'll take a look at a second, at by far the highest level over the past year and the highest level ever, right? Stocks starting to finally weaken here, so we have no problem jumping into the trade with a sell straddle. But we'll first take a look at that implied volatility. So pulled off implied volatility. Here you can see 90-day implied volatility, right? You can see the quick run up, right? It had been trading basically around the 50 range and then just exploded, right? Well over 80. You can see from Monday to Tuesday, that huge run up, right? Even further on implied volatility on those kind of shorter term options, right? Here's a look on a 20-day kind of look back, right? You can see implied volatility, as we alluded to, below 60, now trading around 80 generally. So certainly a huge run up in IV, and this is post earnings on STM, right? Here's where the earnings came out, right? Earnings, were kind of tepid, but the stock rallied like every other chip maker out there. So at some point, I think we will see at least a cooling off, right? Here's a look at the 90-day 50 delta call option on a 5-year look back, right? You can see implied volatility, which is the price of the options, by far the highest level ever in those 5 years. This huge parabolic move, right, means that option prices are absolutely expensive here, which favors selling. Cannot imagine a much further move higher, right, on implied volatility. Here's a look back at a 6-month one on the same chart, right? You can see how it had been hovering right around that 50 level and then explodes along with the rest of the AI names. So this sets up ideally, right, for a straddle sale. So I simply took a look back, went back to May 14th, right, with the stock at 63.40 roughly. The August 75 straddle, right, was trading just under 22 bucks, 21.75, right, with the stock at 63 and change. IV trading right around the 70 level. We'll take a closer look in a second. Fast forward to yesterday's close. The stock closed at 73.32, so up about 10 points, right? That August 75 straddle actually increased in value, even though you had about 30 days time passing, right? So time decay should hit in, right? And even though the stock moved towards almost the ideal price, if you're selling the straddle of 75, that straddle improved in price, believe it or not, because of the huge jump in implied volatility, right? That huge spike that we saw here pushed that price of that straddle to a higher level than it was when it was further in the money on the put side and 30 days earlier. So doing kind of a quick side-by-side here on May 14th, that we said the stock at 63.39, that 75 straddle for August, right? Closed at 21.75, in the money by about 11.5 points. Had a 20 delta, right, because the puts were in the money, the calls out of the money, so a bullish trade if you sold it, right? 9 cents a day in time decay, right? Days to expiration 99. The IV back then just under 70. Fast forward to yesterday's close, right? The stock closed at 73.32. That 75 straddle actually increased by 15 cents, even though the stock went almost to the ideal strike price there of 75. It's now in the money by only $1.68, right? So it's less than being in the money by $9.93. You now have a negative delta of negative 14, and the theta has increased because of that huge jump in implied volatility, and we're nearer expiration, right? 26 days less, right? So you expect to make about 15 cents a day just on time decay, right? Why? Because that IV is now almost at 84. So the fact that the stock moved up and we had a bullish trade over the course, right? I like to use a smooth delta. We started at a bullish 20 delta, ended yesterday minus 14 over that time frame. The smooth delta, about 6 deltas net long, with a roughly almost 10-point move in the stock, right? You'd expect that to drop about 60 cents in price here, right? Time decay, right, as we said. You have theta, right, about 12 cents a day, and we had 26 days come off, so you expect the price of that straddle to drop by over 3 points. So you'd expect the straddle will be trading somewhere around 18 bucks, but it's actually trading at 21.90. Why this massive run up in IV, right? Almost a 14-point pop in IV sets up ideally for a sell straddle trade that is pretty much delta neutral, right? But takes advantage of that huge jump in IV. So we're just looking for a reversion back towards kind of this level here, just a 5 to 8 point reversion, not back down to here, which would be even more ideal, but simply a reversion here. We'll take a look in a second how much that favors it. So I actually did the trade this morning in the account. So here was selling the August 75 straddle, got 21.20 credit on the trade. You can see 2 deltas net short still, even though the stock did drop to 70.58, right? The fact that IV is so high means the call delta is actually still higher than the put delta, even though the calls are almost 5 points out of the money, the put's almost 5 points in the money, all because of that huge IV, right? But as we can see here, selling that straddle, doing it one time would tie up about 1,500 bucks in margin, so not an expensive one. You do need the highest option approval level to be able to sell a naked straddle. And taking a look at the theoreticals, right, I simply pulled off kind of the price I got into it around that 21.20 level, right? You can see that stock at 70.75, right? IV at 83.42, 79.97. So basically 83.5 and 80. That straddle would have been worth about 21.10. If we just keep everything the same except for IV and lower it 5 vol points, not a big drop, right? We're simply looking to go from here in the low 80s to here in the mid 70s. So not looking for any sort of massive vol drop, right? And we have that huge time decay on our edge as well, right? Where we have that huge theta as we talked about, right? On the trade, where our theta every day, right? We're looking at now a 15 cents a day time decay benefit on this too. But if we simply drop the vol 5 vol points, that straddle would be worth under 20 bucks. We're able to sell it, as we said today, at the price that we got into it. We got into that straddle, as we said, at 21.20. So he'd pick up a quick, 130 bucks, right? And that's on $1,500 roughly margin requirement. Not a bad quick return just for that. And then if time passes, we will be able to cover that for a lot less. So hopefully gives an idea how we go about identifying trades here at Big Time Options. We will absolutely keep you apprised of it. But these sort of moves are rare, right? This is a market environment that is giving us opportunities. It might be once in kind of a trading generational lifetime, right? Every 5 years or so that these come along, as we can see. It hasn't been this high in the past 5 years by far. So take advantage while you can on this. And as always, we like to keep reminding that trading is all about probability, not certainty. So position size accordingly, right? Get out when it's time to get out. If you don't know when to get out, you shouldn't be getting into the trade. So until next time, as always, here's the good trading. Take care.